Hello, online ag economics students. This video is for chapter 2, titled The United States Food and Fiber System. The text starts with just identifying different players within the food system. So we have all sorts of businesses that play a role in our agricultural food system. We have businesses that provide input supplies to farmers and producers. So this would be anybody who produces machinery such as Case International and John Deere, anybody that produces feed for animals, which could be a company like Purina. This could be a company that produces seed for crop farms. Any company that sells to producers or farmers makes up the farm input supply businesses. Okay, then we have the actual producers, farmers and ranchers who are growing crops, raising animals, and selling their finished product. Once the food product, crops or animals are finished, they are sent off to a processing and manufacturing business. Lots and lots of those out there. A couple examples: Del Monte Foods, Koblina Cheese Company, Cargill is a grain company. Those are companies that take that raw agricultural product, whether it's meat or whether it's crops, and they process it and make it into something that is sold and put on the grocery store shelf. And then we have the grocery stores themselves. Okay, Walmart, Sullivan's, and we have restaurants that sell this food as well. So that's a whole nother sector of the food system. And then also backing all of these various businesses within the food system are banks and financial lenders that help to do the accounting and do the lending and really run the back end financial aspect of all of this. So those are the companies that make up the food system. And actually under each of these, we could list hundreds and hundreds of companies that are a part of this food system. So the economic activity of all of these businesses is reported and compared year to year through something called an index value. Also, we want to know nominal values and real values, but we're going to start with index values. So an index value helps us to compare from a point of reference how much more or how much less was produced from one year to another, or how much more or how much less something cost from one year to another. So really it's a percentage comparison from a fixed point of reference. For example, if we have a price index of apples in 2019, if we say the price index in 2019 was 1.05 when compared to a base year of 2000, that would mean that in 2019, the price of apples was 5% more than it was in 2000. So price indices and all index values are compared to a base year, a fixed point. So one of the questions on your quiz is going to be that to suppose the index price received by farmers in 2000 was 1.02 and the base year of the index was 1995. Okay, it's not telling us what the farmer is selling, but let's just say it's corn, just for the sake of putting something there. So they're telling us the base year is 1995. So that base year, the index value for that base year is always going to be 1.00. And then they're saying, so that's 1995. Then they're saying in 2000, it's 1.02. So what that means is that in 2000, the price of corn was 2% higher than it was in 1995. So if we look at these answers down here, let's figure this out. So it says relative to 2000, farm prices were 2% higher in 1995. No, that is incorrect. They were 2% higher in 2000. So B is actually going to be the answer that we are looking for. Relative to 1995, because that's our base year, farm prices were 2% higher in the year 2000. So that's kind of how those are interpreted. How they are calculated takes a little bit more work, okay? So if we look at this table, 2.2, we see it says output and price indices for milk. So we have index values compared to the base year of 2000, both for output and for price. When we're looking at output, we are looking at pounds of milk that were produced in that year compared to the base year of 2000. So the base year is given to us, it's told to us right there, and we can also tell what the base year is because 1.00 is always going to be the index value for the base year. So how we calculate the index value for any of these given years is we divide either the output in pounds or the price, depending which we are interested in, and we, for the year that we're looking at, and we divide that by the price of the output for the base year. So I'm going to click to the next page here because we have some more room to work. So this is the same chart that we had over there. We're going to try to figure out what the output index is here, 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 and here. Well, the outputs for the first two and the price index for the second two. So our calculation from the previous slide is that we are going to take the output for the year of interest divided by the output base year. So the first year that we are interested is 1995. The output for that year is 155,292. And we are going to divide that by the output for the base year. Again, our base year is the year 2000, so we're going to divide that by 167,393. So 167,393 pounds of milk were produced that year. So if I type that into my calculator here, 155,292 divided by 167,393, I'm going to get 0.927. I'm going to round that up to 0.93. Okay, so I'm going to go ahead and do the same thing for output in 2014. So I'm going to take the output for my year of interest, which is 206,046, and I'm going to divide that by output for my year of interest, 176,393. Let's see what I get. 206,046 divided by 167,393, and I get 1.23. Okay, so what's this telling us? This is telling us that in 2014, milk producers, dairy producers, produced 23% more milk than they did in the base year of 2000. What it's telling us for the year 1995 is that producers produced 7% less. I took 1.00 minus 0.93, and that's 0.07, which is 7% less than they did in the year 2000. So in 1995, 7% less. Okay? So to do the price index, we're going to do a similar thing. Let me erase some of this. Except instead of output, we are now interested in price. So the price for the year of interest divided by the price of the base year. Okay, so the first one would be the price of the year that we're interested in. So the price of 1995 is $12.74. We're going to divide that by our base year, which is $12.32. Go ahead and divide that out, and whatever you get is going to go in that rectangle. And then you're going to do the same thing for 2014 to get that blank there. Okay, so again, this is going to help us figure out what percent greater than or less than are we producing, or in this case, we're looking at the price. So how much more per 100 pounds are producers getting paid for their milk? Okay, so if we look at this example, 1.17 compared to the base year of 1.00, in 1999, producers are getting paid 17% more than they got paid in 2000. So that's how we interpret those values. This is an example off of one of your quizzes that's directly related to this. So the output produced in bushels and the prices of this output over the last 3 years for Seth Johnson, a farmer in Amarillo, Texas, are as follows. So it looks like we've got data for 3 years here, 2010, 2011, and 2012. And then we've got the output and the price. So it's saying let the base year be 2011. What is the price index for 2012? So we take to get the index equals price of year of interest divided by price base year. So the price of the year of interest is 2012, because that's what we're trying to figure out. That's what we're interested in. That's $3.50. And the base year is 2011, so that's $2.90. So whatever that works out to be, it's going to be 1 point something, right? Because 3 is bigger than 2. And then whatever that is, I guess I'll work it out for you quick. 3.50 divided by 2.90. So that's 1.2. So this is telling us that it is 20%, approximately. The price is approximately 20% higher in 2012 compared to 2011. Okay. All right, here's another example. You might be able to do this one alone, but let's just preview it. Let the base year be 2011 relative to 2011. The price of this commodity in 2012 was higher. I just answered that question on the previous slide. So hopefully you got that. Review the previous slide if you missed that. Okay, the next section of your text discusses the difference between nominal and real values. So a nominal value is defined as the current dollar value for which no adjustments to inflation have been made. For example, if your income in 1980 was $25,000 and your present income in 2020, so 40 years later, is $50,000, your nominal income actually doubled, right? It went from $25,000 to $50,000. However, are you double as well off? Okay, so basically, is $50,000 today worth what $50,000 was worth in 1980? The answer is no, because of inflation, right? The value of the dollar actually has decreased over time when we look at history. So what we could buy with $50,000 40 years ago is a lot more than what we can buy with $50,000 today. So that's as a result of inflation. So to figure out what this, like to compare numbers across years, we have to calculate the real value of the money. Okay, so the real value is the dollar value for which adjustments have been made for inflation or deflation. Sometimes the dollar value increases, which would be deflation. So that allows us to compare numbers across years. The consumer price index is an index value that we utilize to calculate the real value. So in order to calculate the real value so that we can compare money across a wide range of years, we take the nominal value and we divide it by, this should say consumer, we divide it by the consumer price index, okay? So the consumer price index is it tells us the amount of money proportionally that consumers spend on goods and services in a particular year compared to the base year. So, for example, if the consumer price index is 1.09 in 2019, that means that consumers spent 9% more on goods in 2019 when compared with the amount of that they spent on goods in 1982 to 1984, the average of that. So when we calculate consumer price index, we are actually calculating the average spent in 82, 83, and 84. So if we look at these years, 1982, 83, and 84, 82, 83, 84, we add all of these together and then we divide it by 3. That is going to give us our base value, okay, that we're going to set equal to 1.00. So we use the consumer price index to calculate the real values in order to compare inflation adjustments numbers across years. So what we're concerned about at this moment is not, you don't have to understand consumer price index 100%. Do read that section in your book if it's still confusing to you. But the most important part is really being able to calculate the real value of something. Okay, so how we're going to calculate the real value is that we are going to take the nominal value, which is the actual money that was exchanged or earned in that year, and we're going to divide it by the consumer price index. So easy peasy. For 1980, we're trying to find this blank here. We're going to take the nominal value, which is 120,296, and we're going to divide that by 0.824. So when I do that, 296, 120,296 divided by 0.824, we're going to get 145,990. Okay, so that's going to allow us to compare down the line here every single year and figure out if more or less value was actually being made in each of those years. So go ahead and finish calculating out for 1985 and for 1989 on your note sheet. Okay, so this comes up in a quiz question as well. So looking at this table, we see that Farmer Smith over a period from 2008 to 2010 assumed the only source of income is from the production of corn. Also assume that production costs are 0. So the best year in terms of real income for Farmer Smith was, okay, so we need to calculate the real income. The only income that, well, we need to calculate actually the real and the nominal income. So let's make 2 more columns here. Let's do nominal income. And then let's do real income. All right, so the nominal income, so 2008, this producer produced 6,000 bushels at $2 per bushel. So we multiply those 6,000 times $2 to figure out how much cash he actually received. So that's the nominal income. So that's going to be $12,000. And we can do that for this other one as well. 8,000 times $2.60. 8,000 times 260 is going to be 20,800, and then 10,000 times 250 is going to be 25,000. So that's the nominal value across those years. That was the cash that was received. Now we got to figure out the real value. So we're going to take the nominal value divided by the price index. So we have our consumer price index here to figure that out. So we have 12,000 divided by 1. Well, that's going to be 12,000. We have 20,800 divided by 1.10, and that's $18,909. Go ahead and figure out the real value for 2010, and then the highest real income, so the highest out of this column, is going to be the year that you tell, or that you select for your answer. Okay? Okay, the next section of your notes asks for a few equations. So one thing that we're going to look at is the equation for gross farm income. So gross farm income, this is odd how this picture shows up here, but basically gross farm income equals cash receipts from marketing plus any government payments plus income from other farm sources. So in the instance of a grain farm, that would be cash receipts, means cash that is given to you after you sell your products. So that's farm marketing, selling your grain. So if it's a grain and beef farm, it would be cash receipts from selling the corn and the beef calves, if it's a calving operation. So your equation on your notes, you're just going to write cash receipts. And actually, you can write this out however you want. I just don't like how it's really set up here. So I would do gross farm income equals cash receipts from farm products or marketing plus government payments. So most farmers get government payments of some kind for a variety of reasons, and then plus any other income. Which other income from farm, maybe you sold, maybe somebody was in need of manure and you sold manure for compost. Maybe you custom chopped or baled some hay for somebody, so you sold those services. So just other things that you made money for. It is going to be your gross farm income. The nominal net farm income is going to be, that's just equal to gross income minus expenses. Okay, so net just means how much you make after you pay off your expenses. And then the real net farm income, which is not a question on your note sheets, but you're just going to divide that nominal by some sort of deflator value, like we were using consumer price index before, but that's not always what is used to divide it to get your real net farm income that can then be compared across years. Okay, total assets is equal to real estate assets plus non-real estate assets plus any financial assets. So this would be anything in your savings account, checking account, etc. Real estate assets would be like land value. Non-real estate assets would be like machinery value. Okay, so total assets equals land machinery checking savings. So real estate plus non-real estate plus financial assets. Okay. And then your net worth or equity, you hear both terms. So I'm just going to write net worth is equal to total assets minus total liabilities. Total liabilities are any debts that you may have, which, you know, if you owe money on the machinery or equipment, or you owe money on the land, you'd subtract that out. And then net worth is really the money that you actually have left in that could be cashed out. Okay, we're going to skip that one. All right, these next few slides, I just want you to kind of read over yourself and look in, you know, you can read the textbook a little bit, but there's just a lot of statistics that are presented in some of the chapter here. So this is just showing like how many billions of dollars, and this data is a little bit old, 2015, how many billions of dollars each of these products added to the US economy. So for example, dairy products added $35 billion in 2015 to the United States ag economy, or to the United States economy. You know, we can look at vegetables, they were 19. Feed crops, so that would be like corn and soybeans, was 58, and so on. So just go ahead and look at some of those statistics. Here's some more. 1 out of every 6 jobs is tied to the food industry. And the ag industry is responsible for 12 to 15% of the United States gross domestic product, which is, you know, the value that it's worth, and so on and so forth. There's lots of charts. This one's talking about the number of farms over the years. This is talking about how the farm has changed over the years. So we have fewer numbers of farms, but larger sizes. We have increased our use of technology and equipment relative to labor. So a lot of, you know, there's a lot of work that is no longer done by hand, that is done by machine. We've increased our productivity. We can see here some financial information. Nominal net income has grown. That doesn't mean that real net income has grown. Declining debt has been helpful, and we have recovered some real estate values. So land values declined a lot in the mid-1980s, but land values are high again, so that has really helped out farming and the producer. Here's some more information. 10% of United States farms account for 75% of the value of production, which just basically means that there are lots and lots of really large farms and less farmers. Just a list of farm inputs there. So again, take a look at some of these graphs, read about it in your textbook. There'll be some questions probably on the quiz related to this, and there's a spot on the note sheet for you to note some of these statistics that you find interesting. Okay, so we're not going to go through all of these. I just kind of want you to go through those on your own, just to get an idea of trends in agriculture over the years. Okay, this one's kind of neat. Talks about the input expenses in the farm. So the biggest input expenses are seeds and feed, and then fuel is relatively small compared to some of those other expenses. Okay, then we start to talk about the food dollar and what percent of what consumers end up paying for their food the farmer actually gets. So this is a nice depiction. If, you know, of every $1 that is spent on food, the farmer gets approximately 17.2 cents of that dollar. So that's about 17%. So any way that producers, so I guess there's 2 points to make here. Producers obviously are interested in getting a larger percentage of that share. However, there's a lot of work done off the farm to get that product to the table, right? There's processing. We talked about this in the first one. You know, it's processing it into a marketable product, putting it on the grocery store shelf, preparing it at a restaurant, and all of the advertising and marketing and processing that goes along with that. So the farmer is a small part of the picture when it comes to getting food to the table. So this represents, you know, there's a ton of jobs available off the farm that are all related to agriculture. And then it also, you know, is saying that if farmers could market their product in a way that they didn't have to go through all these channels, you know, maybe they could make a little bit more money. So there's a couple sides of that, but you know, it is what it is here. And this is 2014, and that may have shifted a little bit now. So one of the, this is a neat depiction too, where it breaks apart how much the farmer gets out of each of these individual products. So, you know, if they sell tomatoes at the store for $3.29, the farmer is getting 30 cents. But again, I would say, you know, there's lots and lots of work that goes on after the farm to get that product to its shelf, and that's what we're paying for. So unless you want to sell your products at the farmer's market, that's really the only way to get 100% of that share. So here's another quiz question. The retail value of 1 dozen eggs is $2.89. Farmers receive $1.04 for this dozen of eggs. What's the farmer's share of the retail dollar? So basically you're just trying to find what percent of $2.89 is $1.04. You're going to divide that by 289, divide that by 289, and whatever you get there, you're going to multiply by 100, and that's going to be your answer. So as always, reach out if you have any questions. Good luck with this week's problem, this week's quiz, and this week's note sheet.